Hello, welcome to America First Wealth Management Investment Outlook for Monday, March 10th, 2025. We're recording this after the market close on Monday, March 10th. So as viewers do know, markets had a pretty rough day today, and we'll get into some of the details in terms of what we think is driving it. This is our standard disclaimer. This material is intended for informational purposes only. We're not offering any investment advice. We're recommending to offer or solicit to purchase or sell any securities. And our opinions are subject to change as market data changes. We like to begin by giving our market outlook and giving all our conclusions up front and then providing some supporting data. Market highlights last week. We certainly had a fair amount of tariff uncertainty, which created downside volatility, particularly in the US dollar and the stock market last week. The dollar index, the DXY, dropped more than 3%. This was the largest weekly drop since November 2022. The weekly drop in the S&P 500 last week was the worst in the last 6 months. And the S&P 500 index closed Friday at 5,770, which was near the key support 200-day moving average of 5733. And after today's close on Monday, the S&P 500 closed below the 200-day moving average, 5617. So that's certainly a breach of that moving average, which to us means there's either a bounce coming or it could be a period of further decline. What's clearly been driving the market has been the Trump factor. And over the weekend, Trump gave an interview and he clearly stated that he won't rule out a potential recession this year. And certainly Trump tariff uncertainty might lead to inflationary pressures. And for those who study economic scenarios, recession plus inflation is the worst economic scenario, which is called stagflation, which we haven't seen since the 70s under the Jimmy Carter presidency. But we do have to ask the question, is Trump intentionally jawboning the market down to refinance Treasury debt at lower rates? We pointed out previously that there's a lot of US debt that needs to be refinanced this year, about 7 trillion. And 3 trillion of that is short-term in nature, thanks to the previous Treasury Secretary, Janet Yellen. Much of the financing she did while she was running the Treasury was short-term in nature, taking advantage then of the lower interest rates versus locking in longer-term interest rates, which were slightly higher. So those turkeys are coming home to roost this year with the need to refinance a lot of its short-term debt. And we'll point out later, you can clearly see that in the yield curve where the short-term rates are still stubbornly high. And we think that's due to the short-term financing that's going on. Certainly among the stock market leadership has shifted to Magnificent Seven names or Magnificent No More. International and value stocks are outperforming year to date. So that's also a significant shift. In terms of key economic events this week, Tuesday morning, we've got the JOLTS job openings. Wednesday and Thursday will be the key numbers, core inflation, and Thursday morning, the PPI numbers. And Friday morning, the Michigan Consumer Sentiment Index. But clearly the Wednesday numbers and Thursday, the inflation numbers will be the important numbers to watch for the week. We don't have that many S&P 500 company earnings this week. Monday after the market close will be Oracle. Wednesday after market, Adobe and CCI. And Thursday pre-market will be DG. And Thursday after market will be Ulta Beauty. Pointing at the weekly market stats, you can see, with the exception of the international stocks measured by the EFA ETF, everything was down across the board last week, leading the downward plunge was the small growth stocks, large growth stocks, and the NASDAQ Composite and the NASDAQ 100. It was certainly not a good week for the markets. Month to date, no better. We're seeing dramatic decline, and also the quarter to date, which is the year to date. Only the Dow, Russell 1000 Value, and the EFA ETF and bonds are up. So we do see a dramatic shift if you look at the numbers as compared to 2024 and 2023. So we're giving back some of those gains of the last 2 years, obviously, and there does seem to be a bit of an unwinding that's going on. We're not surprised. We pointed out some of these, some of the outlier concerns that we saw previously with the higher S&P 500 PE valuation. Also, the fact that Warren Buffett of Berkshire Hathaway had raised a record amount of cash. And we just sensed that there was some reason to run to the sidelines, especially with short-term rates being so strong, and 2 good solid years of stock market returns. Turning to Magnificent Seven, the only name that was up last week was Alphabet. And year to date, the only name that's up is Meta. Tesla and Nvidia are down the most now year to date. This is after huge leadership by Nvidia for the past 2 years. But as we mentioned, there's a clear shift in market leadership, and the leaders of the past are underperforming currently. Also pointing out, notably, Tesla has been declining precipitously year to date, and we think part of that has been the controversial actions while he's at the helm of Doge, and certainly that may appear to be a distraction, or it's just pointing out that some of the cuts he's made are unfavorable, and people are selling out of Tesla for that. But it remains to be seen. His job is to search for 2 trillion in cuts, and he's trying to achieve that. Obviously, cutting jobs is not a favorable thing, and people are raising concerns, and Tesla's taking a bit on the chin. We've got the indices down below, which we noted in the previous chart as well. Turning to sector performance, the only sector that was up for the week was healthcare. Everything else was down. Some of the defensive names held up, consumer staples and materials. Materials and industrials, in our opinion, when you look at previous periods of falling interest rates, materials and industrials do tend to hold up better. And real estate's also holding up a little better, given the drop in the longer term rates as well. Most notably, we've seen a lot of positive action among the home builders, which is a strong beneficiary of declining longer term rates. Year to date, we still see a number of sectors quite positive. However, if you look at consumer discretionary and tech, those are down the most. Bear in mind that Tesla is in the consumer discretionary sector, so that's probably dragging it down an extra bit more. And we'll we'll continue to watch the developments, but right now the markets are in a bit of a distribution. Turning to the S&P 500 chart, we show the dotted blue. This is the 10-day moving average. The S&P 500 line is in the green. The dashed purple line is the 200-day moving average. As I mentioned before, we're now below that after the Monday close. And the question is, in the past, we normally see a sharp recovery after the first break through the 200-day moving average, so it wouldn't be a surprise to us if we do have a bounce sometime this week. However, we do note that in the past, for example, in 2022, when we had the break below the 200-day moving average, the S&P 500 continued to fall after that. So normally a first break in the 200-day moving average is followed by a rally, but whether or not it continues to rally from there will depend on some fundamentals and also, in our opinion, what the Fed does with interest rates. The RS relative strength index below is showing that the S&P now is in the oversold region. So again, we wouldn't be surprised if we do have a bounce coming sometime this week. Quite possibly if the inflation numbers are softer, but there's also a chance that it could be higher. So we'll wait to see the number and wait for the reaction. The dollar index, as I mentioned earlier, is sharp break now below the 200-day moving average. That's certainly a driver for international stocks outperforming year to date, and also why gold is continuing to be strong. But also in the RSI chart below, the dollar is also oversold, so we wouldn't be surprised in a sharp bounce in the upcoming days. But we're seeing some sharp volatility here because of the tariff talk. Bitcoin, which we've been following because it tends to be a slightly leading or coincident indicator for the stock market recently, is also hitting the 200-day moving average, also oversold. The question is whether or not it bounces here. Trump has certainly made a number of announcements regarding his desire to have a strategic crypto reserve. But we do kind of feel that much of that is rhetoric, and the actual work and discussion and planning is still probably several months out in terms of policy and authority and how that would actually be implemented. So we do expect additional volatility here around Bitcoin and the other cryptocurrencies. Gold looks strong to us. If you look at the RSI, it's neither overbought or oversold, and it's neither extended on the chart, but it's clearly in a good uptrend here. So we wouldn't be surprised if gold continued to head higher. It's over 2,900 now, and we think it'll possibly be crossing over 3,000 sometime this year. 10-year Treasury yields had a little bounce during the week. Last week up 8 basis points, ending the week at 4.32%, and now down, but down 26 basis points year to date. Looking at the yield curve, the top curve is at the end of December 2024. The middle one in blue is last Friday, and month end February is the bottom in orange. So we see a drop in the yield curve year to date, except at the short end of the curve, at the 2 years and less maturity, we still see higher interest rates. We have this inversion at the front of the curve, which is troubling because it does mean that there's supply of short-term treasuries out there. As I mentioned, the 3 trillion in refinancings at the short end. And it's also keeping a lot of investors on the sidelines sitting at that cash level. Warren Buffett, namely, finds that 4.2, 4.3% short-term yield quite attractive. And that's certainly more attractive than some of the volatility we've seen in stocks lately. Um, so it does remain to be seen. The short end, as we know, is controlled by the Federal Reserve uh, rate setting process that they do. The longer term is driven by supply and demand, and that's going to depend on um, how investors are allocating their assets between stocks, bonds, and cash, as well as large institutions and foreign investors in terms of their willingness to invest in longer term treasuries. So historically, inverted yield curves, or even partially ones like the one we're seeing, have been predictors of recession. So we still can't rule that out. And certainly Trump over the weekend said that he's not going to rule it out either. I think it's probably better that if the Trump administration inflicts some pain in terms of restructuring the federal government, it happens earlier in the term than later. You can't make any omelets without cracking some eggs. So I think some of that needs to be done because the public debt now is approaching 37 trillion. And the debt to GDP numbers are quite high. I think they're about 140% debt to GDP right now, which is a very, very high level, and that certainly is not sustainable. And it does take a lot of discipline and cuts to do so. Unfortunately, it's going to create some pain. We've seen it in a lot of layoffs at the federal employee level, and we're seeing some volatility in the stock market. But our view is that we're going to get some longer term gains once things are restructured and the government's more efficient, hopefully, and the spending is less, and hopefully the budget gets balanced. Turning to the economic calendar for the week. Again, I highlighted the key data points Tuesday morning, 10 a.m. JOLTS job openings. Wednesday, we've got core inflation and inflation, 8:30 a.m. Those will be key numbers to look at. Core inflation is looking for 0.3 is the consensus and forecast versus previous of 0.4. Core inflation of 3.2% consensus and 3.1% forecast, a drop from 3.3 on the previous read. So hopefully we'll hit those numbers to be slightly better. Obviously, if the inflation numbers are lower, that kind of gives support for the Fed to cut rates sooner rather than later, but we'll see what happens. PPI on Thursday, 8:30 a.m. Looking for 0.3% consensus and forecast, also dropped from the 0.4% from the previous reading. And we've got initial jobless claims will be consensus 225,000, forecast 230,000. Certainly a rise from the previous of 221,000. That's not unanticipated due to the higher jobless, higher layoffs at the federal employee level. Friday, we got Michigan consumer sentiment. Consensus is 64, slightly down. Forecast is 63.2. So we're looking for consumer sentiment to be a little more negative on Friday. S&P 500 earnings, Oracle, Adobe, Crown Castle, Dollar General, Ulta Beauty. Not a lot going on this week in terms of earnings. markets will largely be driven by the macro data, especially Wednesday, Thursday on the inflation numbers. And we'll see what happens with Trump and Doge this week as well. Hopefully things calm down a little and settle in. We're gonna need hopefully a little bounce in the market off of the technical support levels. So we're looking for some of that. But in the meantime, it probably still pays to keep some dry powder and wait for the dust to settle. And hopefully there isn't a worse correction out there. And the other things we're also looking for is hopefully movement towards a peace settlement between Ukraine and Russia. And hopefully we move towards a a bit of settling down in the Middle East as well, and hopefully moving towards some peace between Israel and Gaza. So those are some of the key geopolitical macro events that we're looking for. And thanks for tuning in to our investment outlook for the week. If anyone would like to reach out to us to schedule a one-on-one discussion to talk about our products and services, please feel free to contact me. My email is listed here or Jim Monahan. And we'll be happy to set up a call and talk about your specific needs. And thank you for tuning in today. And good luck with your investing needs. And we'll talk to you again next week. Take care.